Thinking about getting incorporated? Well, before you do, please watch to the end of this video because I'm going to cover all the benefits of getting incorporated, what exactly is a CCPC, and who should and also who should maybe not get incorporated, or at least not right now. So without further ado, let's get into the video. In today's day and age, starting a business has never been easier. It used to be really complicated back in the day with lots and lots of paperwork, but now it's just simple paperwork, a business name, and a bank account. And basically anyone can start a business. You don't need to be incorporated right away. Now there's two main types of businesses, either a sole proprietorship or a partnership, which is under the same umbrella, or there's also corporations, which we're going to talk about today. Now, a sole proprietorship and a partnership are essentially the same thing. A partnership is essentially just two or more sole proprietors working together in the same business. Now, sole proprietorships have unlimited liability, which means that there's no division from self to the business name. So I'll give an example. Let's say that Tom and Jerry, they own a car wash business, but they're a partnership structure. If, let's say, a customer comes in and they injure themselves on site and they hire a lawyer and they sue, because Tom and Jerry are a partnership and not a corporation, they're actually going to be going after Tom and Jerry individually in a court, which means that all their personal assets, including their mortgages, their cash, their bank accounts, are completely at risk. Sole proprietorships are extremely simple and very cheap to set up, less than $200. So it's a straightforward way to start your business and get off the ground, especially if there's not a ton of liability in the type of work that you do. Now, when it comes to taxation, sole proprietorships are taxed as if you are a self-employed individual. So for example, if your business profits $500,000 this year, you would be on the hook for close to $250,000 of personal income tax. Now, incorporations are a lot more costly to set up because there's additional costs for payroll, GST, EI, and legal fees, as well as bookkeeping and filing fees on an annual basis. But also in the initial setup, it's going to cost anywhere from $2,000 to $3,000 initially to register a corporation. And of course, you can do it yourself for a few $100s, but there's a lot of different issues that could arise, and I would not recommend doing that. I would instead recommend speak to a lawyer so you don't have to go and clean up any messes in the future. Now, the ongoing cost of running a corporation, it's going to depend on the business, but typically in terms of filing fees, it's going to cost anywhere from $1,000 to $2,000 on an annual basis to continue filing for your corporate taxes. But when it comes to legal liability, corporations provide a significantly higher barrier to becoming the subject of a lawsuit. Let's say you own a business and someone decides to sue the business and is awarded the assets of the company. If you own your car personally and you own your house personally, in most circumstances, those assets are going to be protected because they're not considered as business assets. And therefore, it provides a separation between your personal assets and of course your business. Now, another huge benefit of incorporations is that we're only going to be taxed on our profits. So any money that the business earns is considered as revenue. And the revenue each year is going to have expenses taken off of it. So let's say we have salaries, different staff on payroll. We also pay ourselves a salary out of that as well. The remaining amount that's left over after all expenses is considered as profit. And that is the amount that's going to be taxed at a corporate level, not the entire amount. So we don't pay tax initially, we pay tax later on when we actually file. Now, you might wonder, how much tax do we pay on that profit? Well, a corporation, for any money that's kept within the business, at the end of that business year, it's taxed at a corporate level, which for the first $500,000 of profit in a year is taxed usually between 11 to 15% in Canada, depending on the province. So let me give an example. If we have a sole proprietor that makes $500,000 in a year, and they end up deducting $200,000 for expenses, the $300,000 that's left over, they're going to pay personal income tax on it. So they might end up paying 45 to 50% on average in taxes, and they're only going to keep $175,000 out of that. But a corporation owner, let's say they make $500,000 in a year, but they have $200,000 of expenses. So the $300,000 that's left over, that is going to go towards the tax. And the corporate tax rate of 11% means they're only going to pay $32,000 to $33,000 in taxes on that, depending on the province. So that is a very, very big difference. And this is why doctors, dentists, and many other professionals get incorporated because of the major tax benefits. You can choose how much you want to pay yourself every year as a salary or in the form of dividends. So for instance, if a business owner only has 50 grand a year of personal expenses like their mortgage and groceries and everything else, they can pay out enough salary to cover just those personal expenses. And then the rest of the money stays in the corporation where it then gets taxed at that 11%. And another major benefit to corporations is when they're being sold, the business owner has a lifetime capital gains exemption as of 2024 of $1.25 million, which means if the business was worth nothing at the start and now the business is sold for $1.25 million, they will pay zero tax on the sale of the business itself. And that, my friends, is a humongous benefit for business owners that are looking to eventually exit and sell their business later on. But let's compare that to the example of buying real estate and selling that. If we bought a $500,000 property and then we eventually sold that for $1.5 million, half of that $1 million profit that we made is going to be taxed as a capital gain. So that means we might pay $250,000 in tax in 1 year just for selling that asset. And all that money goes to the CRA instead of in your pocket. Now, one thing to be very careful of is investing within your corporation. If you own real estate or stocks or other mutual funds or investments, and you have any kind of capital gains or dividends or any interest, you're gonna get taxed at a rate of about 51%, depending province to province. So let's say Bob, for example, has $100,000 in his GIC. This year, his GIC earns 5%. He earns $5,000 of interest. Then he has to report that interest as income. So when he files his business taxes, 51% of the $5,000 will go to the CRA. So Bob only kept 49% of his interest earned on the GIC, giving him a 2.4% interest rate instead of 5%. Now, I have a totally separate video on how corporations are taxed where I go over this in more detail, but you get the point. So investing inside of a corporation requires careful planning and the right strategy. Now, the question is, should you or should you not incorporate now? Well, the answer to that is that it depends on how much profit you're making and taking home every year. For instance, if you're making $100,000 of pure profit in your business each year, it probably makes sense for you to look into incorporating. But if you're also earning income as a side hustle, but you have a full-time job and all your side hustle income is just getting saved in your bank account, then it might make sense for you to incorporate as well. Because the extra money that you're earning, you're not spending it and you don't need that for bills. You may as well benefit from a lower tax rate at the corporate level, as long as you can save about $10,000 per year or more in taxes. Remember, there's still $2,000 to $3,000 a year of setup costs and filing fees that you need to consider. So if you're gonna save $10,000 by incorporating, then the math is mathing. You may as well get it done. But if not, you might wanna wait because it's gonna cost a little bit of upfront money as well as those ongoing fees every year. Now, there are some disadvantages to incorporating aside from just the cost. And the one major one is if you're trying to get a loan, such as a mortgage in the next few years. If you incorporate and you pay yourself the minimum amount of salary just to survive, most banks don't consider your corporate income nearly as much as your personal income. And so therefore, it could bite you in the butt if you're trying to get a mortgage in 2 or 3 years, because it makes it look like you're not earning that much income and it makes it look like your income is less consistent. And if you overlook this step and you don't plan ahead, it could be very frustrating down the road when you're trying to get that qualification. So the main question you want to ask yourself is, do you want to save on taxes, or do you want to be able to borrow more money or get a mortgage? And last but not least, corporations do not have a corporate TFSA. So using tools like corporate-owned life insurance to grow money tax sheltered within a corporation can be extremely advantageous and can be extremely beneficial. Even when we consider the cost of the insurance, it can still be a major benefit to our finances long term. And it's definitely something to look into if you have a corporation, because it could save you a lot of cost and a lot of headache in the future as well. Hope you all enjoyed the video. Leave a thumbs up if you did, and I hope to see you all in the next one. Take care. Have a wonderful day.